What's up, guys? I hope you're doing well. James here from jamesdforsyth.com. Again, continuing on with the a premiere on money, and kind of elaborating a little bit on yesterday's video of the two-tiered kind of banking system, or at least that Patman argues that we have. And by that, what I mean is they have the first layer or whatever with the commercial banking system, where they have the public feed into that, meaning the public's checking accounts go for the commercial banking system. And then on the second tier above that, you kind of have the same thing. It's just instead of the public, you have the commercial banks, and instead of the commercial banks, you have the Federal Reserve, as he argues, right? And so what I really want to elaborate on is like how the reserves and the commercial bank deposits kind of are different, specifically with respect to like the reserve requirement. So we're going to be looking specifically at a section in which he talks about what is the formula that determines the maximum amount of money and credit available to business and consumers. So he's really talking about like what is the total amount of bank deposits that can happen, basically, and he gives a formula which is just A times B equals C. It's three variables, and it's just a simple product, right? Where he's multiplying the amount of bank reserves by essentially how much that can be multiplied by the commercial banking system. As he defines that, he's saying the number of dollars of deposits member banks may create per each dollar of reserves, right? So basically, take the amount of bank reserves, multiply it by how much the commercial banking system can make that, and then that equals your total amount of bank deposits, or the maximum amount, I should say. And he does give some technicalities. So he says the Federal Reserve Act does specify certain maximum and minimum limits within which these authorities may change either part of the formula, meaning the amount of bank reserves or the reserve requirement. But these limits are extremely wide, and that's pretty much a lot of his argument is we need to constrict the limits or even take them away altogether to where the government's fully in charge of that. That idea is kind of laced throughout the entire book. So where he really goes with this, it's his main argument for the different parts of the formula is basically, in terms of the total amount of bank deposits, it really doesn't matter what changes, whether that be the amount of reserves or the reserve requirement. And remember, or keep in mind, I should say, this is back, and this was written in the 1960s, and so this was decades before we had 0% reserve requirement as we do now. Back when this was actually a thing. And that's one of the things I thought was rather interesting, is to see whether or not that comes back. But that's a rabbit hole not to go down to it into this video specifically. And so basically he says when the Federal Reserve increases the money supply by lowering reserve requirements, all of the new money is created by commercial banks through their lending and investing activity, right? So essentially, you're keeping the amount of bank reserves consistent, or the same, and then you're changing how much the commercial banks can multiply that. And so the only thing that changes is the commercial bank's activity, right? Because commercial banks cannot create bank reserves. The Federal Reserve does that, right? And they essentially do that by crediting the commercial bank's checking account, in a way, their reserve account, right? Okay, so on the other hand, when the Federal Reserve uses the increased reserves route by purchasing a government bond, some of the money is created by the Federal Reserve. And this goes back to a little bit of what we talked about in the previous video, where how when the Federal Reserve creates bank reserves, bank reserves are considered high-powered money because basically the Federal Reserve can create them, right? And then there's increase in money there. And then the commercial banks have the ability to multiply that into bank deposits that do circulate in the real economy. And that's one kind of nuance that is really kind of necessary, especially with the argument for inflation and everything else. Specifically, we'll go with consumer price inflation. For that to happen, you have to have an increase in the money supply circulating in the real economy, right? Just because that money is on a bank's balance sheet doesn't necessarily mean that it's in the real economy, right? It could be being held there, it could be in some financial asset, maybe some kind of derivatives or insurance play that regular kind of people or individuals aren't privy to, stuff like that. We're talking about basically money that goes in and will compete to buy more pizza, to buy more gasoline, to buy more whatever. That's kind of the difference between the types of money, right? In that respect. Okay? And so further, the larger portion of reserve created money, the more the U.S. Treasury benefits, because all income of the Federal Reserve after expenses reverts to the Treasury. Thus, the Treasury receives a good share of the income earned by the government securities purchased in the reserve money-creating operations. So essentially, what he's saying is, for the Federal Reserve to create more bank reserves, they typically do that through some form of asset purchases. That's when you think of quantitative easing, it's really just kind of an asset swap from the perspective of a commercial bank. All they're doing is switching their bank reserves all they're doing is switching their whatever asset it is, whether it be an agency, MBS, mortgage-backed security, or it be some form of U.S. Treasury, and they're giving that to the Federal Reserve is buying that from them in return for bank reserves. And so you're essentially just changing the different types of money that commercial banks are holding. Because when you look in the grand scheme of things for commercial banks and money market funds and other things in the Eurodollar / shadow banking system, cash isn't the only form of money. You can use bank reserves if that specific entity is eligible for them, if they have a reserve account. Not all of them are, but if they do, that's an option. They can also use treasuries for the same thing, essentially, at least they have the same effect on that scale, right? And obviously there's some nuances that play into that, but it's the concepts that we're talking about. And so other types of those kind of short-term, I guess liquid instruments would be a good way to describe them, that are essentially used as money. So like you could think U.S. Treasuries as a form of money with that the commercial banks can use to that extent. And it's basically money that creates interest. So what cash is to you, bank reserves are, well, no, they changed that. But, sorry. So, cash for an individual doesn't produce interest, right? The physical cash in your hand, it doesn't do anything. You put it in a bank, you get a little bit of interest, whatever. Or you can put it in some other security, right? So, it's kind of the same idea for, or I guess what used to be for bank reserves before the Federal Reserve started doing interest on them for commercial banks and for other depository institutions. So now that argument's not quite, that analogy isn't quite as tight, but if you also look at, say, or for treasuries, for the commercial banks, they produce interest and everything else. Anyways, I don't know. I started that thinking it was going to be an amazing analogy, and then kind of thought about it more and how things have changed since then, and it's not quite as tight, but anyways, continue on. Sorry for the rabbit hole, but okay. So, the Treasury, right. And so basically when the Federal Reserve, his argument is that the reserve created money, when the Federal Reserve creates bank reserves and essentially does QE, buys assets from specifically treasuries or some other interest-bearing asset from a commercial bank. That interest-bearing asset, say it's a U.S. Treasury, just to keep everything simple, is now held by the Federal Reserve. So the Federal Reserve now gets the interest, right? And so he's saying that basically by the Federal Reserve monetizing government debt, that interest stays within the government system, meaning lower taxes for citizens, because the interest that's being paid is being paid to the Federal Reserve, which at year end, the excess of the Federal Reserve's profit, I guess you could say, will get basically deposited into the TGA. So it's given to the Treasury, right? Whereas if commercial or private banks buy those treasuries, they receive the interest, and then the taxpayer is essentially having to fund that debt and fund that interest and give money to the commercial banks, because the government still has to pay the debt, right? So that's part of his argument. Okay, so yeah, I already stated that. I'm just trying to keep going. So, and another thing that our technicality, he says specifically with bank reserves, so many of the smaller bankers who are on the whole not as well versed with the mechanics of the money system as they might be actually believe that they have deposited a portion of their money or their depositors' money with the Federal Reserve. Thus, they feel they are being denied the opportunity to make profitable use of this money. Accordingly, there is always agitation to have the Federal Reserve pay the bank's interest on this money, which they think they have deposited, in quotes, with the Federal Reserve, right? And so the bank reserves themselves aren't deposits they're not deposits at the Federal Reserve, right, is his argument. And so essentially how you go to the bank and get a mortgage is what the bank does for bank reserves with the Federal Reserve, right? They can go to the discount window or some other lending facility nowadays and basically get bank reserves and borrow bank reserves from the Federal Reserve. And so it's much the same dynamic to where it's credited to their reserve account, right? Right, and it even says explicitly, the truth is, however, that private banks collectively have deposited not a penny of their own funds or their depositors' funds with the Federal Reserve banks, because there's basically, the bank reserves are essentially created for that purpose, right? And again, nothing the banks can do will increase the total amount of reserves on high-powered money in the system, and nothing the banks would care to do can decrease the total amount of reserves in the system, right? Because that is essentially just privy to the Federal Reserve, right? So, reinforcing that topic, he also goes on and gives a little bit of a story of him going around to the reserve banks and asking if you, like, can I see the money and everything else. It's like, these bank reserves, can I actually see them? Can I see the gold you guys have deposited? Like, go walk into the vault and everything else. And he even says, let's see, specifically, he asked to see the cash reserves on deposit with the Federal Reserve, and to quote him explicitly, he says, "This time my question was met with some looks of surprise. The bank officials then patiently explained to me that there were no cash reserves. The cash, in truth, does not exist and never has existed. What are called cash reserves are simply bookkeeping credits entered into the ledgers of the Federal Reserve banks." Right, so even back then, it was essentially just interbank ledger money, or as you hear from Jeff Snyder and the like, for like the for the Eurodollar University podcast, he calls them interbank tokens, right? Kind of, or that's what he calls bank reserves, at least. So, yeah. There's a lot of nuance and technicalities, but the more you kind of essentially just study it, it starts to make sense, and really kind of how things flow throughout the system starts to at least seem less foreign, and it's easier to understand. But yeah, so the main purpose of this video specifically was a lot of to talk about the little technicalities and stuff between, like, where the money's flowing and what exactly that means and stuff like that. So it's kind of, a lot of this has to do with the whole, like, QE is not necessarily inflationary. At least that's one topic you could take it into. As long as, in terms of consumer price inflation, again, there's different types of money, and the kind of, I guess you could say, is like physical laws, for lack of a better analogy, that kind of dictate how that money flows, right? Whether that be more of like legislative regulation or just best practices within the banking system in general. So anyways, I'm going to leave it there. So I hope you guys have a good night, and I'll see you on the next one.